Good afternoon, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Monday, and it's April 23rd. Hey, and my apologies here. We got this out late today, and so we're getting kind of close to the close of the market. Probably about within an hour for the stock market, and within 2 hours for the bond market. So my apologies here. Just had kind of a busy morning here, and was just able to get this out for you now. Now, here's where we are. We have on the economic calendar, we got the market manufacturing PMI flash for the month of April. So the previous reporting came in at 55.6 and then it went up. So manufacturing shows upward trend according to market on their indexes, and it went up to 56.5. So anything above 50 on these two indexes are basically optimism or growth, and anything below tends to be obviously a contraction or a little pessimism. Now on the services side of it, we show from a 54 jumping up to 54.4. So good overall economic news releases. And last but not least, we have the existing home sales for the month of March. So it went up, as you can see here, for the month of February from 5.54, even though it showed a forecast of actually going down a little bit. It went up to 55.6. These are annualized units of what it's on pace for. And of course, we've been seeing a 3.6% month supply, which is one of the lowest on records in terms of inventory that we have out there. So if we had obviously more inventory, it's possibly we would see much higher numbers here. But these are still good numbers in terms of what we have available in the market, and home prices still show continuing trend of going upwards in value here, or in prices and such. Let's take a look at the headline news. Stock market did start off about mixed earlier, and since it has come down in prices. We did get the 2018 Q1 earnings reports being released today. But the big thing is it's just they're starting to realize that the spread between the 2-year and the 10-year yields are actually closing, and what that means is that once you get like an inverted curve, which means when short-term rates are higher than the long-term rates, that means it kind of forces us into a recession. And if we get to, and last week it did touch 0.41%. And if you look back around November, we were actually as high as like 0.73. So this is just as the Fed is raising the short-term rates, is that spread is closing much more. And right now, today, with the yields, as we'll see later on, are up, but we did touch last week at 0.41, and the Fed's been raising rates at 0.25% increments. So that basically could put us on pace even by end of this year to next year at what they call flat curve, or potentially a inverted curve. So a flat curve is basically where short and long term are at the same level, and inverted curve is when short-term rates are more expensive than long-term rates, which essentially, since I've been kind of tracking these, it's been basically a precursor to a recession. And what that means. So here's the bond market. Bond market's down now about, it's been hovering between 9 and 12 basis points so far this morning. We're kind of seeing right on the second Fibonacci level, which is kind of keeping us afloat here, and hoping that this holds, because it could drop a lot further, which in turn basically is enough to raise interest rates. So interest rates have been climbing as a result of this. Especially since we got squeezed underneath this 25-day moving average. It's just been kind of pushing down further and further. And this has been a pretty strong floor of support, but it did get kind of pushed down. So we'll have to kind of see if this, again, continues to be the trend, if it's going to continue pushing us further down. And same like over here, this has been a very strong ceiling of resistance here, and today it broke above that. We're approaching that 3% level, which we haven't been in like 4 years. And that could be a psychological level where it could keep pushing this up. So as a result of this is what boosts us from 4.1 to about 0.5% in the yield spread change between the 2-year and the 10-year treasury here. So but right now it did kind of break above this ceiling here, and we'll have to kind of see if it's going to continue it. Now we're getting this wick, which is kind of showing some weakening here, and that's kind of helping us out here. Same thing here at the bond market. We're seeing 2 wicks here. So which one ever stronger? Hopefully this pushes us further down, and this will help out mortgage-backed securities and hopefully give us a little bit more of a boost and not stay down in that level for too long here. But to kind of move along here, rates did go up as a result, so pricing for interest rates did increase a little bit today from where we left off on Friday. That wraps everything up. If you guys want to come over to Twitter, you can always follow me on Twitter. I do post over on Twitter different items there as well. If you guys want to get that, I'm at Mike Bjork on Twitter. Otherwise, enjoy the rest of your day. Thanks so much for watching. And tomorrow I should have this on time for you in the morning. All right, you guys have a great rest of your day. And again, thanks for watching. We'll see you guys tomorrow. Bye bye.